I have 10 o'clock, so I'm going to go ahead and get started today. First off, I want to thank everybody for taking the time to join us for this webinar. My name is Scott Cameron. I'm the Chief Investment Officer for Multnomah Group and a principal here. We're going to be talking today about evaluating target date funds and the process that we think you should be going through as plan sponsors or working with your investment advisor to evaluate what's becoming one of the largest portions of plan assets as we see it in defined contribution plans. Before we get started, a few housekeeping items. We are recording this presentation. We'll be posting it to our website in the next few days, so if you are interested in I guess, rewatching it or sharing it with others, it'll be available on our website in a few days. We'll also be providing all the attendees a copy of the slide deck, so you should be getting an email from us as well sometime after this in the next couple days with a copy of the slides for your just for your files as well. There's a question panel on the GoToMeeting panel. If you have any questions as we go along, feel free to submit them there. We have everybody on mute just to keep the background noise down, and we'll try and get to those questions either through the presentation or at the end. Certainly if you have a question later on or we don't get to it, you know, I'll reach out to you if you submit it, or anything comes up, feel free to contact me or one of our consultants if you work with them directly, and we can get your questions answered. So we're going to talk a little bit about target date funds today, and starting with, at a high level, an overview of the qualified default investment alternatives. That concept is really what's aided the growth of these funds. So we'll provide a little bit of a background on what a QDIA is and why we're seeing all the use of target date funds. Provide then kind of an update on where the target date fund market is today. Talk a little bit about the guidance that the Department of Labor has provided to us so far, and spend the majority of the time on the selection process and the evaluation process of these target date funds. So the concept of a qualified default investment alternative, or a QDIA, really originated with the Pension Protection Act of 2006. Most defined contribution plans prior to the PPA had a default investment option, but were typically using as the default a cash-like vehicle, a money market or stable value, maybe a general account product. The Department of Labor's objective in creating the QDIA was to ensure that the default option was an appropriate choice as a single investment to meet a worker's long-term retirement savings need. And I think that's really important to understand. Most people prior to the Pension Protection Act had used the stable principal option within the plan as the default, because the concern was that there was some liability if they put it into something that had more equity risk and experienced losses. And really what the department is saying is the default option is needs to be focused on kind of the long-term needs of participants, and therefore they really set out 4 categories of products that qualified as a QDIA. First is a product with a mix of investments that takes into an account the individual's age or retirement date. And that is target date funds. One of the 4 categories there, the first one is really what we're going to be talking about for the rest of the hour today. They also said you could use an investment service that allocates the contributions among the existing investment plan options that would account for an individual's age or retirement date. So that's you know, most frequently takes the form of something like a managed account service, where you use the core funds in the investment menu and you use a software overlay to allocate amongst those and change that over time. The third option is a product with a mix of investments that takes into account the characteristics of the group of employees as a whole rather than each individual. So as a plan sponsor, you could choose a balanced fund if you thought that was appropriate, looking at the demographics of your plan as a whole. And then the last option is a capital preservation fund. And you could only use that for the first 120 days. of participation, and after that you have to default somebody to one of the other 3 categories. So with specifying those 4 categories, what we found is that it really pushed a lot of interest in that first option, a product with a mix of investments that takes into account an individual age. The capital preservation products were no longer attractive because the default of that for 120 days, then having to redefault somebody isn't operationally very simple. Using a single balanced fund can work for some plans, but does create the challenge of you have people that, because of their age or their risk tolerance, are either going to be overly conservative or overly aggressive. So using age, which is a readily available data point in these plans, and having different choices for younger and older employees has really pushed the interest in target date funds. It's important to understand, though, that the creation of the QDIA created a safe harbor for plan sponsors meeting those guidelines, but that safe harbor really just protects you from participants coming back and saying that it was an imprudent choice to default me into that fund, into the age-based fund. It doesn't create a safe harbor. It doesn't eliminate any requirement that you have as a sponsor or as a fiduciary to go through a prudent process of selecting that QDIA option and continuing to evaluate that on an ongoing basis. It's not a blanket statement that says that anything that uses age in its name or it's an investment philosophy is a good product. So target date funds existed before the Pension Protection Act. The first products were launched in 1994. After a decade, at the end of 2013, there were 16 target date fund series with relatively small portion of assets in them. Beginning with the Pension Protection Act and since 2006, we've seen a huge growth in the industry. There's now 52 unique target date mutual fund series, an additional 44 collective investment trust products, as well as insurance separate accounts and a number of custom target date fund options that may be used by plan sponsors. Importantly, it's in looking at the target date universe as it exists today. It's over $615 billion in assets at the end of 2013, and as we update that through 2014, I'm certain that that number will go up. It's a market that is heavily dominated by a few providers. You can see Fidelity is the #1 provider at the end of 2013. I think they maybe have flipped places with Vanguard, but $185 billion in assets, or almost 30% market share in the target date fund space. Vanguard and T. Rowe Price are 2 and 3, and between the top 3 providers, you have 75% of the mutual fund assets in target date funds. What is not surprising as we look at this and understand the history of these funds, those firms that have the greatest market share are those that have strong record-keeping presence and therefore have a lot of proprietary fund usage on their record-keeping platform. We do have a mix of others. The top 10 providers are listed there. And while we say there's 52 target date fund series, you can see that the top 10 fund families account for over 90% of total target date assets. So there's a long tail of smaller providers, but it is a market that certainly is very top-heavy with only a handful of providers north of $100 billion in assets. Given the big growth that we've seen in target date funds, it's certainly not surprising that it's drawn the interest of regulators. There's been a number of proposed rule changes that would change disclosure requirements and things that we need to communicate to participants. None of that has really moved forward. And what we have so far is the Department of Labor has given us some guidance on how they think we should be looking at these products. And this is something that they put out in 2013. The URL there will take you to a copy of their guidance. It's really a 2-page thing that in most cases I think is pretty much common sense. It said we need to establish a process for comparing and selecting target date funds. We need, as plan sponsors or plan fiduciaries, need to establish a process for the periodic review of selecting those funds. the selected funds. So we need to have good process when we pick them, but once we pick them, we don't get to wash our hands of that decision. We need to continue to monitor those on a periodic basis. I also said it's important to understand the fund's investments. And what they're really saying is, how does the fund allocate between major asset classes, stocks, bonds, and cash, and how is that going to change over time? We need to understand the fund's fees and the investment expenses built into those products. And they've also said you should probably look and determine whether a custom or non-proprietary target date fund would better fit your plan. And really, I think that gets to the fact that as they look at the data, most plan sponsors historically have used proprietary options that are in some way tied to their record keeping. And that is not, from a fiduciary perspective, you can't say, well, that's what they offered me, and so that was really the only choice I had. They explicitly said you need to look at non-proprietary options and even look at custom target date funds, if that makes sense. They also said you need to develop effective employee communications. As we look at the huge growth in target date funds, one of the negatives that comes up most frequently with these is that they're effective in getting people into something that's appropriate for their age. Most employees still don't have a good sense of what they're invested in. And where that seems to come up as a problem is when periods of market decline, like we saw in 2008, people that thought they were in a 2010 fund thought maybe that there was some sort of guarantee that came with that at retirement, and those funds declined in 2008 along with all other assets. And so we need to do a better job telling our employees what their target date fund consists of. And then lastly, and this is true of really all the fiduciary decisions that we're making, we need to document the process. Having the process in place without any documentation doesn't really provide you any benefit as a fiduciary. So document the information that you received, the data that you looked at, and the process you went through in making this decision. So what they've said is we need to establish a process for evaluating these funds, both initially and then continuing to monitor them. We think that a prudent process really looks at a few different areas. First, it starts with looking at the capabilities of the investment management firm, then looking at the construction of the glide path, or how the portfolios change in allocation over time. Then looking at the asset classes that are used in the product and how investment management is implemented. And through all this analysis, expense is an important thing that we need to keep in mind as well. What we'll find oftentimes is that there are some trade-offs between cost and these decisions as to glide path, to asset allocation, to implementation, and we need to keep in mind that cost has a pretty big impact on participants' ability to accumulate a successful retirement balance. So we start by looking at the investment management firm. We think this is really important because these products kind of fundamentally shift the relationship that we've had historically with an investment manager. We're taking the responsibility that has historically been on the participant in a defined contribution plan or on a planned fiduciary committee in a defined benefit plan, the responsibility for building a portfolio and shifting that from the participant to the fund manager. The fund manager historically was responsible for security selection within their mandate, the fundamental research of buying and selling stocks or bonds. But we're also giving them an additional responsibility that says you need to build the right mix of portfolio for us. Because we're doing that, we need to have a better sense of that firm and then their stability, the experience that they have doing that type of work, their commitment to the business, the people and processes that are in place, and the resources that they're committing. Start with stability. How stable is the organization? Target date funds are designed to last for a participant's lifetime. So if you're 25 years old and starting out, you are potentially investing in this target date fund for 70 years. During that time frame, these funds are going to need to grow and adapt. Any glide path or product that's built today, we should have an expectation that over time they're going to make changes to adapt to new asset classes as they come to market and become more liquid, as the market changes in dynamics, and as new investment research is conducted. While we can make changes in target date fund series in our plan over time, in our experience there's a very low appetite for frequent turnover of the target date funds. As these funds have become the default option and we see growth in terms of the number of participants and the amount of assets that they have there, if we're frequently chasing newer target date fund series or hotter products, I think it tends to erode the confidence that plan sponsors have in us as fiduciaries and plan sponsors. And so, our expectation is that we are with these target date funds for the long haul. And because of that, we want to know that we have a manager that's going to be stable over time. The second question that we have is, what experience does the firm have in creating global asset allocation portfolios? So we look at the market today, most investment management firms have been successful because of their unique skill in managing a single asset class product. You think of the star managers that manage maybe in a large cap growth universe or a small cap value universe. Their skill is within that kind of universe, buying and selling the best securities. Switching the asset allocation decision to the investment manager means that they need to have a different skill set than what most of them have had historically. In some cases, you can demonstrate that skill set by managing these target date funds for a long time, but because this is a relatively newer asset class, we have to also look at other experience that they might have that could be relevant. Some managers may come to target date investing having done outsourced pension work before. Maybe they have a background doing investment consulting, or maybe they've managed target risk portfolios. Some have been around managing target date funds long enough that experience is relevant as well. So we need to understand what their capabilities, what experience they have there. And then we also need to understand really who's doing the work. Some of the firms have done this by outsourcing a portion of that allocation work to a third party. So they might say, I'm a good stock picker, I have good products, I don't want to have to develop the asset allocation expertise in-house, so I'm instead going to go license somebody else's research. Most of the products that we see on the market choose to do that internally, but it's important to understand who really owns that process and who's responsible for the asset allocation. The commitment's, another important piece that goes back to the stability and longevity. Commitment's important because we have seen as the Pension Protection Act came about, a land grab of sorts of people launching these products, trying to gather assets, knowing that a large portion of defined contribution plan flows are going to go into these products. We have seen a number of fund series that didn't get the traction that the fund sponsor hoped for, that have since been liquidated. And given the fact that we want to be with these products for a long term, we want to make certain that they're committed to these. We look at things like, do they have a dedicated staff for managing them? If this is a side job for the stock fund portfolio managers, it's not a good sign of commitment to the business and our expectation that they're going to continue to keep these evolving as best-in-class products over the long term. Are they a core portion of the assets that they manage? Do we have sufficient traction in the market to support long-term viability? I think that's key. We don't want to pick a fund that somebody comes out with and says, hey, this is great, we're doing something different than everybody else, only 2 years down the road for them to say, yeah, you never really got caught on with the market, we're getting out. And we also want to look and say, what type of thought leadership are they putting into this? Are they advancing the target date fund industry by putting out research that explains why they're doing what they're doing or where they think they need to evolve? That's important in giving us better transparency into how they're managing the fund, but also as a sign that they're committed to the products that they have. As we look at the people that are involved, as we look at these firms, the firm really comes down to the people that are involved. What experience do they have managing asset allocation funds? How long have they been managing target date funds? And what other responsibilities do they have? Certainly our preference is for folks that are dedicated to these products and not just doing this as a side job along with their day job at an investment manager. And as we see more asset growth and scale, we're seeing that trend of having dedicated portfolio managers and asset allocation teams that are responsible for managing these process over time. As we look at the process that these firms have, again, knowing that there's going to be changes, or our expectation is that these will continue to evolve, do they have a defined process for how the product will evolve and evaluating potential changes that might come into place? We do see in different market environments, following periods of big equity losses or big equity gains, there can be a tendency to react to peers and to markets and make changes. Our preference is for somebody that says, here's our process, here's how we follow it, and if we make changes to these products, you'll know that we'll have gone through this methodical method, or this method for evaluating those changes, and we're not just reacting to what has happened in the market recently. As we first evaluate the investment management firm, the second thing that we're looking at is the equity glide path. And what we see here is just a very hypothetical glide path. What we're talking about is how, over time, as a participant ages, the portfolio will evolve. And at the highest level, we're really talking about the split between stocks and bonds. It's very common the farther you are from retirement that you start at a high equity allocation. And as you get older and near the retirement date, the equities or stocks in the portfolio will decline and the bonds will increase as we assume that you become more risk averse. There is not a one-size-fits-all glide path. Each investment management firm has their own glide path methodology. And in our research, we don't think that one is right and all the others are wrong. It really is dependent on a variety of factors. For a plan, it's important to consider the employee demographics, things like average income levels, future wage growth, employee turnover, the existing asset allocation of employees, and financial literacy. Is an example of how demographics might impact this. If you have a high employee turnover, picking a glide path that assumes that your participants will continue to be invested in this fund through age 80 or 85 probably isn't consistent with the actual experience of participants, and you therefore might want to be more conservative. Income levels can impact the income replacement at lower income levels. Social Security tends to replace a larger portion of your income in retirement, and so the gap that you need to close through the plan is smaller than if you have higher paid individuals who have a larger portion of their retirement income that they need to replace through the plan. Plan design can also have an impact. Is there complementary defined benefit plans? What's your defined contribution plan look like? What's the match or grant level that might be involved in that? Are you using any type of auto features? Those things can have an impact as you look at the glide path and what an appropriate glide path is to replace a certain level of income. Certainly the more money that you put in, either through employer contributions or auto enrollment and auto escalation features that increase average deferral percentages, the less equity risk you potentially need to take to replace that income. And then the last thing to consider at a plan level is the fiduciary considerations. As plan fiduciaries, what's your knowledge level? Some of these products are very simple to understand and to evaluate on an ongoing basis. Others have very complicated underlying investment strategies, and picking a product that doesn't match your comfort level or knowledge level as a fiduciary, I think, can create some challenges. Similarly, understanding your comfort level with risk and how you define the the problem that you're trying to solve with target date funds. Are you trying to optimize for the average participant a certain level of income? Are you trying to meet a certain minimum threshold for participants? That impacts your comfort level with risk. At a fund level, in selecting a glide path, there's a few things to look at. You'll commonly hear a discussion of to versus through in evaluating target date funds, and in a slide or two we'll talk about the differences between those. That's one valuation point I think is too often used as a shorthand for a more complex analysis of these, but it's important to understand whether you're using a to versus through product. Looking at things like the beginning equity level. So if you're starting out at age 25, how much in equities do you have? When do you begin to transition to something more conservative? How steep is that transition? At what point do you reach your most conservative allocation, and what is that? Are you 30% stocks? Are you 50% stocks? All those things need to be evaluated in looking at the glide path. As we talk about to versus through, the to retirement funds are really funds that get to their most conservative point at the retirement age, which for these products we generally assume is age 65. We see a couple different rationales for why plan sponsors have developed a to retirement glide path. There's really two theses that have been put forth. One is a human capital thesis. And what they look at and say, what we care about is your total capital, which is composed of your financial assets and your human capital, which is the present value of all your future earnings. For most people, the present value of their future earnings is highest right when they start in the workforce, because you're going to have the most years of salary. And that is a bond-like asset. It's relatively stable year to year. You might get pay increases. Maybe there's potential for gaps there in that income if you lose your job or go back to school. But for the most part, it's a stable flow of income over time. And so you look at the present value of that. It's very large when you're young, and it's relatively bond-like in its performance. Your financial capital at your starting point is very small. You have very little to nothing saved when you're starting. That, therefore, can be more equity-oriented. And as you age, your financial capital grows, your human capital declines. And so as the human capital, which is bond-like, declines, we need to offset that with declines in the equity risk that we had in our financial assets. So that's one theoretical basis for the to retirement. At retirement, your human capital is kind of exhausted. You have no income coming in the future other than Social Security, and so it doesn't make sense to continue to decline the equity allocation after that point. The other thesis that we've seen put forth of why a to retirement approach makes sense is that most of us in developing these target date funds use a hypothetical approach to participant behavior. We say somebody starts at age 25, they save 6% of pay over their life. Maybe they increase that to 10% over a few years. And if they save 10% a year until age 65, this is what they get. This approach has actually looked and said, people don't actually behave that way. They don't start saving that young. They don't have the 1% a year in real increase in wages. And as they get closer to retirement, they start to take money out sooner than we would expect. Because there's greater uncertainty towards the end of when people take money out, they've said our goal is really to get you to that end point. Beyond that, you need to work with a financial advisor or do some additional planning. There's too many different alternatives at the end for us to continue to assume that you're going to stay in this fund until age 90 or 95. So they've said, we've looked at it, how people behave. There's a lot of uncertainty near the end. Let's focus on getting you there rather than worrying about what happens after that. So the impact that has, because you're reaching your most conservative allocation at retirement, typically you start transitioning earlier, and you have more conservative allocations to equities in the near retirement years. These funds typically also then merge away into an income fund at that retirement date. So if you're in a 2015 fund, probably towards the end of this year or early next year, that fund will get merged into the income fund for the 2 retirement series. Through retirement, we see the focus here is really on either mean reversion of assets or longevity risk as being the primary risk that we face. The idea being that we have very long time horizons. Equity risk is minimized over the long period. And even at the retirement date, you have a 30-plus year time horizon until the end. And so we can afford to take on more equity risk. Some also look at it and say, people are living longer at age 65, given their likelihood that they or their spouse together, one of them might live to age 90 or 95. We need more equities in our portfolio to counter the risk of running out of money at the end. What that translates to is these products typically continue to decline in equity allocation for a number of years after the retirement date. In some cases, it's 5, upwards of 20 years. So you'll still see in the market 2010 funds, 2005 funds that are continuing to get more conservative as they get older, even though we've passed that date. Because they have a longer period to decline that equity allocation, they're generally more equity-oriented at retirement, at the retirement date, than 2 retirement funds. And why we see people use 2 versus through a shorthand is really for kind of risk level. The assumption being a 2 retirement fund's more conservative, a 3 retirement fund's more aggressive, and people saying one is better than the other. Personally, we think that both, depending on demographics and goals of the plan sponsor, can make sense. What we do find is that the providers that have gone this route are typically very adamant that their methodology is in some ways significantly superior to everybody else. I would say that while we see a lot of discussion on 2 retirement strategies, if we just go back and say where the market is today, the top 3 providers, and I think if you got into 4 and maybe beyond there, are all through retirement target date funds. So 75+% of the market is in through retirement glide paths. As we look at the market then, why glide path is important is the impact it can have on the performance of individuals in the plan. What we don't see is starting out is very much divergence in what people think are appropriate allocations. What you can see there looking at 2050 funds is the most conservative glide path that's out there is about 80% stocks. The most aggressive is 100%, where we see most of the people are between 85 and 95% equities. Not a wide dispersion of what people think is appropriate. But as we get older and get nearer to that retirement date, we see a wider dispersion in what investment managers think is an appropriate allocation to equities. At 2015, the most conservative allocation is 25% equities. The most aggressive says that it still makes sense to hold 78% of the portfolio in equities. There's over a 50% gap there, or space between the most conservative and most aggressive. And why that's important is, frankly, for the 2050 investors, you have very little money saved. So the performance difference between somebody that's starting out and putting in money in an 80% versus 100% equity portfolio isn't, from a dollar perspective, going to have a great deal of difference. As you get closer to retirement, you should have the maximum retirement savings, and we're seeing at the period of time when people have the greatest amount invested, we're seeing the greatest disparity between what people think is appropriate allocation to stocks. And so that wide variance there leads to very different outcomes for participants in different target date series. Different way of looking at that, through this, we'll talk a lot about kind of the 2008-2009 time period because it gives us a good test case of a period of market decline and recovery. In this case, we looked at two different fund families, one that we would describe as an aggressive glide path and one that we would describe as a conservative glide path. And the darker blue is the performance of those funds in 2008. And what you see is the 2010 fund. In 2008, the aggressive portfolio declined by 26%, almost 27%. The conservative portfolio was down 10.75%. The 2050 funds, you see the aggressive was down 39%. The conservative was down almost 36%. So again, for those people that are farthest from retirement, the difference between an aggressive and a conservative glide path is marginal. In this period of significant market decline, it was a 3% difference. For those people that were nearing retirement and only 2 years from retirement, the difference between aggressive and conservative was a 16% differential. That glide path has the greatest impact for people nearing that retirement date. It's not just a downside number, though, as well. What we saw in 2009, as you look at the recovery, the aggressive glide path certainly provided more of the upside as the market recovered, up almost 28% versus the conservative glide path that was up 12.75%. Glide path, specifically as you near retirement, can have a huge impact in the variance of your participants' experience versus what other target date funds might provide. So as we look at the evaluation process, we looked at the firm and developed an understanding of what capabilities they have. We've looked at the glide path and the decisions that they've made, why they've built the product the way they have. The next thing that we want to look at is the asset class allocation within the glide path. When we talk about glide path, we're really talking about that stock-bond split. Some people might add cash or a few other asset classes. But the asset allocation decision is typically within the glide path allocations, the split between stocks and bonds. How do they define what types of stocks and bonds they're going to put in the portfolio? First, we need to understand what asset classes are included. And from there, we can make a decision as to whether we think that's sufficiently broad enough exposure to the opportunity set that global capital markets provide. If the fund said, we're going to have an S&P 500 index and a Barclays aggregate bond index, and that's our two things, and we're going to allocate between those two and become more conservative over time, it's probably not sufficiently diversified from a target date perspective for us to be comfortable. So we want to know what they're including and then make a decision as whether we think that's enough. We also want to understand why or how they got to the point of determining what was suitable. What type of modeling was done to determine whether the asset classes included were appropriate and the mix that was done is reasonable. Do they use capital market assumptions in their modeling? Capital market assumptions are really just estimates for the expected return, the expected volatility, and the correlation. A very common input into modeling different asset classes to determine the asset allocation that's appropriate. Some people use historical data. Historical data is readily available and it's definitive. It's data that's easily to come by. The problem with it is historical data isn't very accurate in predicting future performance. If you look just at bonds, historical bond returns over the past 30 years are very attractive, primarily because we've been in a period of significant decline in interest rates. With the 10-year Treasury now around 2%, forecasting those same level of returns for bonds that we've seen historically is probably not an accurate representation of what we're going to see over the next 30 years for fixed income. So forecasting future returns is, I think, more appropriate, but when you're forecasting future returns, there's certainly greater uncertainty into those numbers, and understanding what their assumptions are important. If they think, for example, emerging market stocks are going to return 15% a year for the next 30 years, there needs to be some check of whether that's a reasonable assumption or not. The second thing we look at in terms of determining how they got to the answer on asset class selection is what impact does the fund's investment product capabilities play in determining asset classes. Potentially asset classes could be excluded because the manager doesn't have a product in that asset class. I've seen that with an investment manager that didn't have an emerging markets fund for a number of years. And so you looked at their target date fund and they didn't have any allocation to emerging markets. They eventually got around to launching an emerging market fund, and not surprisingly, shortly after the launch of that fund, they made the decision that emerging markets made sense in their target date fund. So is there anything missing in these funds because they don't have that product? The kind of flip side of that is to say, is there anything in here because they have that product that we might otherwise might not allocate to? We see that with some of the more esoteric asset classes or niche asset classes. I've seen a provider that had a really strong preferred stock investment management team, and they had a product there that not a lot of investment management firms had. Not surprisingly, when they did their analysis of target date funds, they were big believers in preferred stock as an asset class, and so had an allocation to preferred stock when most others didn't have that. That can happen from time to time, and understanding what bias they might bring to the table, I think, is important there. And then looking at how frequently do they review the asset class structure. As we mentioned earlier, markets evolve. New asset classes or new products come to market and become more liquid. How often are they going to look at those changes? Have they made any recent changes in the asset classes utilized, or how they allocate to those? And what potentially are they contemplating now that might impact these portfolios in the future? So we look at these products. Most of them have a standard set of asset classes. Cash, intermediate bonds, large cap U.S. bonds, large cap U.S. stocks, small mid-cap stocks, international equities, very common asset classes. We've seen a growth in additional asset classes start to take hold in these products. We group them kind of into two buckets. You have the portfolio diversifiers, and these are asset classes that are included because the investment manager thinks they either enhance the returns potentially of the portfolio or serve a risk reduction, reduce the overall volatility. Things like stable value, high yield bonds, global bonds, preferred stocks, small cap international, emerging market stocks. And we're seeing things even become a little bit more complicated. We see some investment managers implementing tail risk hedging strategies, volatility management portfolios that are dynamic, either to reduce risk or potentially capitalize on a return enhancement. The second group of asset classes that we see kind of being added more commonly are what we'd consider to be the real return hedges. So, one thing that some managers focus on more than others, but I think is a real risk for investors, is the inflation risk in their portfolio, and the fact that over time inflation is going to erode the purchasing power that those participants have, and how do we provide some hedge of that to these investors. TIPS, Treasury inflation protected securities, commonly used. You also see things like commodities, real estate, either REITs or potentially directly owned real estate and natural resources stocks. Those are typically added with the thesis being that they provide some inflation protection to investors in these target date funds. Asset class can have a big impact on return differential as well. So we talked a little bit about how differences in glide path can impact performance. The asset allocation within the glide path can also have a pretty significant performance impact. And so again, we're looking at 2008 as being a period of extreme market stress, and how did these funds hold up. What we did is pick two funds, a 2010 fund, Fund A, and a 2015 Fund B. And if you look at the Russell 3000 index, is really their U.S. equity exposure. Fund A had 42% allocated to U.S. equities, Fund B had almost 50% allocated to U.S. equities. So that top-level analysis that looks at glide path allocation would say that Fund B is more equity-oriented and therefore we would assume riskier. But what you can see is within that broad grouping of equity and bonds, Fund A had an almost 16% weight to high-yield corporate bonds, whereas Fund B had only a 3% weight to high-yield corporate bonds. In 2008, high-yield corporate bonds declined by 26%, and what was an almost 13% differential in allocation to high yield translated to a pretty significant performance differential. The 2015 fund, Fund B, was down 24%. Fund A, which at a glide path analysis level we thought was more conservative, was actually down over 30%. So glide path is a good measure of risk, but it's not the only measure of risk, and we really need to understand within that portfolio how they're allocating to stocks and bonds. You know, Fund B also benefited from the fact that they had 22% in government bonds, and in a period of declining equities, government bonds did well. We're up over 12%. So the combination of lower high yield, higher government bonds made that fund perform better, even though it might have appeared at first glance to be a riskier portfolio. Asset allocation and the inclusion of specific asset classes can have a pretty significant impact on the performance of the fund. Once we've determined the suitability of the firm, the glide path, and the asset allocation, then we get to how are they actually implementing the investment management capabilities here. We see commonly active or passive strategies, and potentially in some cases becoming more common hybrid approaches. So active portfolio management, seeking to outperform the benchmark, adding additional value on top of the glide path and the asset allocation decision by identifying better securities within the individual mandates. They might be trying to do that either through market timing or through more traditional security selection. Active portfolio management strategies are typically more expensive than passive alternatives and create a higher hurdle rate for outperformance on a net of fee basis. But to the extent that you can find those that can add value, certainly that extra value or alpha can contribute to enhancing participant outcomes. On the other hand, passive portfolio management seeks to provide market rates of return and do so at a low cost, either by tracking through replication or sampling specific benchmark indices. One of the things that I think is important to understand as we talk about active or passive strategies is we're really talking only about the underlying investment management implementation. All of these funds are active in the sense that the investment manager needs to make a decision about the glide path that they think is appropriate and the asset classes that they include. There is no standard benchmark for those that is a passive alternative. When we talk passive management or active management, we're really only talking about how do they implement the portfolios, the asset classes that they've chosen. Lastly, we do see some growth in hybrid portfolio strategies. I think there's an understanding by some investment management firms that either they don't have the capabilities across all the asset classes, or in certain asset classes it's more difficult to add alpha, and so they're utilizing a combination of active and index strategies. In some cases it lowers the cost because there's some combination of passive lower cost index funds, but it's not in all cases, and as we've looked at it, the cost differential between the hybrid portfolios and active portfolios is pretty minimal. It's not like they're getting as inexpensive as the all index or all passive portfolios are. They're still closer to the active management fees. So evaluating whether active or passive makes sense, I think you need to look through the products and look at the usual criteria that we use for evaluating managers in these target date universes. Looking at core managers' people, process, investment philosophy, the costs they have and the capacity that they have to manage in those in that asset class. Certainly active management adds an additional layer of risk that needs to be evaluated, but with that additional layer of risk comes an opportunity for outperformance. There are, I think, some potential conflicts that come, especially with the use of proprietary managers, so you need to evaluate what the process is for selecting active managers. How does the target date fund manager go through the process of evaluating and picking the managers that they're using to implement their strategy? And what happens if the manager underperforms? If you're a proprietary fund manager using your own investment options, does the target date PM have the capability to terminate and replace an underperforming manager, or are they stuck with what they're given because it's their own product and that's the only choice they have? On the passive side, I think you use the usual criteria that we use in selecting investment index managers: costs, experience with indexing. And indexing, well, certainly is more automated than active management. There is some skill and some experience that's needed to manage indexing well, especially in asset classes where you might not be able to replicate fully an index by buying everything in that index. There's skill in using sampling techniques to track closely the index. And that's true, I think, primarily on the fixed income side, but also in some of the less liquid asset classes that might be indexed within a fund. And then does the target date fund provider have a broad enough set of index strategies to give us the exposure they want? Are they, because they want to be passive and low cost, are they limiting the universe in some way? It's something to consider. So we looked at active management of target date funds, and at the end of 2014 looked at the prior 60 months. There was 43 target date fund series that had at least 5 years of history, and we ran a returns-based style analysis to model the asset class exposures of all those funds over the past 60 months. Using that custom style benchmark, we evaluated the alpha that these funds created. And what we saw is that 8 of the 43 target date funds had positive alpha on a net of fee basis. So less than 20% were able to create positive alpha or excess returns. The highest average alpha was 2.64%. You can see that outlier in the bottom of the chart. The lowest average alpha was negative 1.45%. The average was a negative 30 basis points or 0.3% annualized alpha. And so what you can see is if you're using active management, it creates a higher burden that you have to go evaluate. The folks that net to fees can add value across multiple asset classes in these products is a small universe, and there's a lot of folks that, at least looking historically, you would have been better off on using a passive strategy on a net of fee basis because they weren't able to add alpha across all of the different components that go into a target date fund in a way that's positive for participants. Talk a little bit about the active-passive split. With that comes proprietary versus open architecture as well. Proprietary investment management is when all the underlying portfolios in a target date series are managed by the same manager. Certainly proprietary products are the most prevalent form of target date funds in the universe. There can be the potential of perceived conflicts when a manager is using all proprietary funds. I think that gets back to the question of what capabilities do they have to manage in those asset classes? What do they do if a manager underperforms? What autonomy do they have to hire and fire managers internally? Open architecture uses best-in-class managers that could be separate from the target date fund manager. So in the large cap growth and the intermediate bond, going out and finding the best investment manager regardless of who the target date fund manager is. Open architecture approaches aren't very common in mutual fund target date forms. They are more common in collective investment trusts, and they're also one of the rationales that people are using for looking at custom target date fund series. The downside is it does add an additional layer of fees potentially to these funds to pay a target date fund manager and the underlying sub-advisors when they're not a single provider. And just because a product is open architecture isn't a guarantee of better performance. There's still a high hurdle of, are we picking the best sub-advisors? Are we managing them appropriately? Open architecture does eliminate some of the conflicts, but doesn't necessarily translate to a guarantee of higher performance. And then similar to the active-passive, there's hybrid approaches where you might use some of your own managers in the asset classes you think you have capabilities in, but you'll sub out to other firms when you don't have that capability. That can also certainly protect against the downside of mediocre performance, but also can create some conflicts of how do you evaluate when it's appropriate to use proprietary versus a sub-advised strategy. And through this all, cost is something that is important. The higher the cost, the greater the hurdle rate. Long-term small differences in cost can add up to significant differences in accumulated dollars, and so we are always trying to drive, to the extent possible, costs as low as we can. Active management is an added cost that we need to calculate whether we think is beneficial. Some asset classes that are more esoteric or niche can be additional costs that we have to determine whether that's a value add. And similarly, more aggressive glide paths, equities are typically more expensively managed than bonds, so that can add to the cost as well. So we look at that initial selection criteria. The ongoing criteria is pretty much the same. It's really, has anything changed with our analysis? Are the changes in the firm? Are they making changes in the glide path, the asset allocation, or the investment management that would cause us to reevaluate these products? That is kind of an ongoing piece. The second piece is, is the behavior of the fund consistent with the expectations? As we look at how they've performed in different market environments, is that consistent with what they tell us they're doing from a glide path and asset allocation methodology? If you had a very conservative glide path and in a period of strong market returns like 2009 or 2013, they were beating their peer group significantly, that's a red flag to us that something isn't consistent with our expectations. We should expect conservative funds to lag peers in periods of up markets and also to provide performance in periods of down markets. So we want to make sure the behavior is consistent with our expectations. And then also, how are they doing compared to other alternatives? Our goal isn't to make changes frequently, but understanding how other people are managing within this mandate can be beneficial in determining whether we continue to be comfortable with the fund. As a wrap-up, at a basic level, I think there's a few things that every plan sponsor should be able to answer. What are the capabilities that my target date fund management firm has in this asset class? Is the glide path that we've chosen consistent with our own investment objectives and the demographics of our plan? What asset classes are included in our products? How are they managing them, and what do these products cost? If you're not able to answer that, then I think additional work needs to be done to get comfortable with the default option that you're using in your plan. As we come up on our hour, certainly want to take any questions that people might submit. That's the extent of our presentation. Again, we'll be posting a recording of this on our website. We'll be sending out a copy of the slides to everybody that attended. If you have any questions, feel free to ask now, or feel free to reach out to myself or one of our other Multnomah Group consultants, and we certainly can help you. Great. I'm not seeing any questions, so I'm going to wrap up at this time. Thank you again for taking the time to join us this morning.